Partnerships are flexible in how they split tax items. Unlike S-Corp, you're not locked into ownership percentage. Partners can agree to split profits, losses, and specific deductions in different ways. On the EA exam, the trap is assuming capital percentage equals tax percentage. For partnerships, you always start with the partnership agreement, then ask if the IRS will respect it. Special allocations are allowed if they have substantial economic effect. High level, that means the tax allocation matches the real economic deal. If one partner gets extra depreciation deductions, they should also bear the economic burden or benefit tied to that allocation. EA exam tip: if the allocation looks like it's only for tax savings with no real economic consequence, it's a red flag. Profit and loss ratios can be totally different from capital ownership. A partner might contribute most of the cash, but agree to a smaller profit share after getting paid back first. Or a partner with key expertise might get a larger profit share even with a tiny capital contribution. The exam loves this. Capital percentage is not automatically the profit-sharing percentage. Guaranteed payments are different. They're payments to a partner for services or for the use of capital, determined without regard to partnership income. Think of it like a salary substitute, but the person is still a partner. The partnership generally deducts it, and the partner reports ordinary income on Schedule E, and there's no withholding like wages. Here's a classic exam move. Guaranteed payments are excluded from Section 199, a qualified business income. So if a partner gets a guaranteed payment for services, that amount is not QBI to that partner, even though it's ordinary income. It also reduces the partnership's ordinary income that flows out as QBI to everyone else. If you see 199A mentioned, immediately ask, is this a guaranteed payment? Separately stated items are the partnership's way of saying, this item keeps its character at the partner level. So the partnership doesn't net everything into ordinary income. Instead, items like capital gains, charitable contributions, Section 179, rental income, and foreign taxes get broken out on Schedule K and each partner's K through 1. Why it matters: partners apply their own limits, like capital loss rules, charitable limits, passive activity rules, and foreign tax credit rules. Don't forget the big Section 199A inputs that get separately reported. Partnerships report W-2 wages paid to employees and UBIA unadjusted basis immediately after acquisition because partners may need them to compute the QBI deduction limitation. On the EA exam, you're often not calculating the full 199A deduction here. You're identifying what must be separately stated and why. Cedar Ridge Manufacturing, LLC has two general partners. Ethan owns 75% and Marcus owns 25%. During the year, the partnership has gross receipts of $625,000, business expenses of $145,000, a Section 179 deduction of $50,000, long-term capital gains of $300,000, and rental income of $25,000. What is Ethan's share of the partnership's ordinary income? Think about it. What counts as ordinary versus separately stated? The answer is $360,000. Ordinary business income is gross receipts minus business expenses. $625,000 minus $145,000 equals $480,000. The Section 179 deduction, the long-term capital gains, and the rental income are separately stated items, so they do not reduce or increase ordinary income. Ethan gets 75% of $480,000, which is $360,000. The tempting wrong move is subtracting Section 179 in the ordinary income number. Valeria owns a 30% interest in the Summit Gear Partnership. All partners share profits and losses by ownership, and there are no limited partners. The partnership reports $90,000 of ordinary income for 2023 and distributes $23,000 in cash to Valeria. How much income does Valeria recognize on her return, and what's the character, especially for self-employment tax? Think about it. The answer is $27,000 of income, subject to self-employment tax. Valeria is taxed on her distributive share, whether or not cash is distributed. 30% of 90,000 is 27,000. And because there are no limited partners and it's ordinary trade or business income, it's treated as self-employment income. The tempting wrong answer is using the 23,000 distribution as taxable income. Distributions usually aren't the income number.